Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of December 9th. If it's your first time, thanks for joining us. And if you're a regular, we're glad to see you back. As always, the purpose of this content is for me to share my background in economics with you to help you better understand the economic reports and the financial markets so you can make informed financial decisions. So with that said, let's go ahead and hit the books and get up to speed on the markets. So looking back at last week, our headline topic was unemployment. So at the beginning of the week, we saw the job openings and labor turnover survey out of the Bureau of Labor Statistics, and it actually showed us that the job market, although cooling, is not in a bad place. We added 400,000 new job openings in October. We added 228,000 quits, but we also saw a small drop in hiring. And you may wonder why I'm saying quits as if it's a good thing. And in fact, most analysts and many economists believe that when we see the amount of quitting, voluntary separations increasing, it shows that workers are confident that they can find a new job or that they can find a better fit. In general, we view this as a positive thing, and we view it as a sense of optimism among the labor market. Towards the middle of the week, we saw the ADP private employment report, which actually showed us that 146,000 private sector jobs were created in the month of November. And although this is less than the 233,000 that we saw in October, this was still a significant amount. And interesting enough, we saw the majority of these jobs being created at the largest firms, those representing 500 plus employee institutions. Closing out last week, we saw the National Unemployment Report from the Bureau of Labor Statistics, and we saw a very positive 227,000 jobs added. This was significantly more than the 12,000 that were documented in October, but on an even more positive note, we actually also saw a revision to the September and the October reports that increased the total amount of jobs created by about 56,000 across those 2 months. Again, remember those revisions are designed to be slightly more accurate. They capture additional data and additional information that was received after the initial report was published, so they tend to be a little bit more reliable than the initial numbers. We also saw significant gains in long-term permanent sectors such as healthcare, which is another positive indication that although the labor market has slowed from last year, it continues to be strong and relatively healthy, with a few problems that, as always, continue to need to be addressed. Around the middle of last week, we also saw some comments from current Federal Reserve Chairperson Jerome Powell. Specifically, 3 things he mentioned I think are important enough to repeat here. The first one is he again stressed and reiterated how important it is for the Federal Reserve to be able to make interest rate decisions without political influence. He also mentioned that he continues to be optimistic that he and the rest of the Federal Reserve will be able to work with the Trump administration to continue to fight inflation and continue to do what's best for the economy. Last of all, he mentioned that given the recent data and given what we're currently observing in the economy, that the Federal Reserve believes they can be a little more cautious in their interest rate cutting. The economy seems to be better than they thought it was in September, and December will give the Federal Open Market Committee a chance to sit down, reflect on the most recent data, and consider how their approach may evolve in 2025. Last week in the financial markets, we saw all three of the stock indices break records at one point, although by the end of the week, the Dow Jones Industrial Average ended the week down slightly, while the S&P 500 and NASDAQ continued to climb. There is some ongoing concern within the stock market that the current prices and valuations are incredibly high and possibly overinflated. At the same time, we've also seen earnings for the majority of companies continuing to grow. So as long as the prices rise and the earnings rise simultaneously, it's anybody's guess how long this bull market might last. It's definitely important to exercise caution, continue to watch the markets, and continue to consult with your financial advisors and financial experts in general. An up market can be exciting, but there's always a potential for a slowdown or even a correction. Shifting our focus to the fixed income market, we saw the yield on the 10-year Treasury both rise and fall this last week, rising from a low of 4.1 to a high of almost 4.3%, but finishing the week down near 4.12%. Well, it finally happened last week. Bitcoin broke the $100,000 per coin mark that we'd been watching for since the election. All it took was the nomination of a pro-crypto regulator to the U.S. Securities and Exchange Commission, who oversees the securities and financial markets. And we saw the Bitcoin value pop above 100,000, although it did in the following days fall back slightly underneath that threshold. Although there continues to be a lot of enthusiasm around Bitcoin, some analysts and economists warn that the coin seems to be overvalued and the market seems to be overleveraged, and it is quite possible that in the future there could be a significant correction, possibly even driving the value of Bitcoin back below $90,000 a coin. Some of the explanations for how this could take place, the first one being that some longtime holders of Bitcoin could attempt to capitalize on the higher prices and cash out in order to gain the profits. Or it's possible that some current holders of Bitcoin may shift their holdings into other cryptocurrencies, such as XRP or Ethereum, who currently seem to be underpriced compared to the increase in the Bitcoin market. Either way, we continue to watch Bitcoin and we continue to try to understand its ability to function as a legitimate commodity and as a value-oriented tradable currency. Finally, looking at last week, we saw the value of the dollar, gold, and crude oil fluctuate a little bit, each in their own way, but ultimately end the week at a very similar place to where it started. Although crude oil was down a little bit from the beginning of the week, neither of these three markets moved in significant ways over the last 5 days. Shifting our focus to this week is going to be all about prices and inflation. The first report we'll see will be the Consumer Price Index. Last month, it came in at 2.6%, with the core being excluding food and energy, coming in at 3.3% over the last 12 months. The big question, of course, is whether inflation will continue to stagnate around this same level, or will we see significant movement either in the direction of our fight against inflation or possibly in the direction of a resurgent inflation. In addition to the Consumer Price Index, we'll also see data from the Producer Price Index for last month. This report last month actually came in higher than expected. So the big question for this week will be, do we continue to see the same trend of higher than expected inflation, or do we see this Producer Price Index start to move back in the direction that we are hoping it will as inflation slows down? Finally, towards the end of this week, we'll see data on import and export prices. This is important because it helps us understand a little bit better the international trade picture. But more specifically, it's important because those import prices have a direct impact on consumers, as well as a direct impact on the input costs for American companies who input materials and commodities in order to produce their goods. Specifically, the manufacturing sector tends to be highly sensitive to changes in import prices. We also care about the export prices, in part because of a lot of American agriculture and a lot of American manufacturing exporting their finished goods to the rest of the world, to countries like Mexico, Canada, and China. In the past, we haven't paid as much attention to these price indexes as to the other ones because they tend to be a little more volatile. They tend to capture a lot of the global fluctuations that go beyond just the United States economy. But given the ongoing conversations about trade, protectionism, and tariffs, these price indexes will most likely become a more significant part of what we are studying to understand the impact of our trade policy on American companies and American consumers. On the equities side of things, this week we'll see some big earnings reports coming out of Broadcom and Oracle. Last quarter, these earning reports actually caused a significant stir in the technology sector. So as the week unfolds, we'll be watching for these reports, hoping for positive results, but also attempting to understand and interpret the market's reaction to the data coming out of the technology sector. Looking a little bit further into the future, the next big event on the economic calendar is the meeting of the Federal Reserve, or more specifically, the Federal Open Market Committee, in order to make their final interest rate decision for 2024. This announcement should be released on December 18th, but in addition to the interest rate decision, we'll also receive from the Federal Open Market Committee a report called the Summary of Economic Projections. The SEP is essentially a way for each of the members of the FOMC to share their opinions or their projections for what they think the economy is going to do in 2025. The reason this is important is because once we have the chance to read these projections, it'll actually give us a better idea of what the interest rate decisions or what the Federal Reserve's decisions may look like over the next 6 to 12 months. It'll also help to reiterate any support or any concern for the specific parts of the economy moving into the future. On the equities side, we're quickly approaching the end of the fourth quarter and the end of the year. Earnings projections have been extremely optimistic, with FactSet.com measuring that the expected earnings growth in the fourth quarter for the S&P 500 should be around 12%. This is significantly higher than the 5.8% that we saw in the third quarter. So the big question, of course, that we'll be watching and we'll be considering is whether this optimism is justified or whether it's simply irrational exuberance. As we continue to operate in a high price, high value market environment, the question, of course, is can actual operations, profits, revenues, and earnings keep up with the increases in prices? We'll be watching all these things as well as anything else that comes up over the next few weeks as we wrap up 2024. We'll be doing our very best every week to bring you the most helpful and the most insightful information in the economy and the financial markets to help keep you up to speed on the markets. Thank you for joining us. As always, if you found this video helpful, don't forget to like and subscribe below. Check out some of the other great content here on our page. And don't forget to join us again next week with our next update and all the exciting information that unfolds as we approach the end of the year. Have a great week.